If you have a traditional 401k or IRA, the IRS has already scheduled a forced withdrawal from your retirement savings. And when it hits, it could push you into a higher tax bracket and cost you $40,000 or more over your retirement years. Most people sitting on $500,000 or $800,000 in a 401k right now have no idea this is coming. Your bank knows, your plan administrator knows, nobody told you. What I am going to walk you through today is exactly how this works, why the IRS built it this way, and most importantly, what you can do right now to reduce the damage before these forced withdrawals begin. This is not complicated once someone breaks it down honestly, so let's do that. Let's start with the basics, because most people were never properly explained this rule. An RMD, a required minimum distribution, is a mandatory withdrawal that the IRS forces you to take from your traditional retirement accounts starting at a certain age. We are talking about traditional IRAs, 401ks, 403bs, 457b plans, SEP IRAs, simple IRAs. Almost every tax-deferred retirement account you have is covered by this rule. For most retirees today, RMDs begin at age 73. That age was recently increased from 72. And for certain younger cohorts, it is scheduled to increase again to 75 starting in 2033. But do not let those gradual changes lull you into thinking you have unlimited time. If you are in your 60s right now, age 73 will arrive faster than you expect. Here is why the IRS created this rule. When you contributed money to a traditional 401k or IRA, you got a tax deduction up front. The government was essentially saying, pay us later, not now. RMDs are how the IRS collects that deferred tax. They are not going to let your account grow untaxed forever. At age 73, they require you to start pulling money out, and every dollar you withdraw is taxed as ordinary income. The calculation works like this. You take the balance of your account on December 31st of the prior year, and you divide it by a life expectancy factor published by the IRS in something called the Uniform Lifetime Table, which you can find in IRS publication 590-B. That table assigns a factor to each age, and that factor shrinks every year you get older, which means the percentage of your account you are forced to withdraw goes up as you age. The IRS is deliberately accelerating the withdrawals over time. Here is where it gets dangerous, and this is the part almost nobody warns you about. The IRS gives you a small grace period for your very first RMD. Instead of requiring it by December 31st in the year you turn 73, they allow you to delay that first distribution until April 1st of the following year. That sounds like a gift. It is actually a trap for the unprepared. Think about what happens if you take that April 1st extension. You take your first RMD by April 1st. Let's say that is $30,000 from your account. But your second RMD, the one for the current calendar year, is still due by December 31st of that same year. So you are taking two taxable distributions, $30,000 and another $30,000 in the same calendar year. That is $60,000 of forced taxable income stacked into 12 months. I had a viewer write in about a retired nurse who did exactly this. She delayed her first RMD thinking she was being smart. At tax time, she discovered two things. First, the extra income bumped her into a higher bracket. Second, her Medicare premiums went up. Both hits in the same year, entirely because of the timing of that first withdrawal. That Medicare premium issue has a name. IRMAA. That stands for Income Related Monthly Adjustment Amount. It is a surcharge, a penalty in plain language, that Medicare adds to your Part B and Part D premiums when your income exceeds certain thresholds. And the income Medicare uses is from your tax return 2 years prior. So an RMD heavy year now can raise your Medicare bill 2 years from now. At higher income tiers, IRMAA can add roughly $600 to $700 per month or more to a couple's combined premiums. That is real money. Here is something the financial industry never says out loud. A very large traditional 401k can be a liability in retirement, not just an asset. Let me show you the math. If you have a $1 million balance in your traditional 401k at the end of the year before your first RMD, your initial required withdrawal can easily land in the range of $35,000 to $40,000, all of it taxable, all in 1 year. Now add that to what you are already collecting. You are probably taking Social Security by then, possibly $20,000 to $30,000 a year. Maybe you have a pension. Maybe you have interest or dividend income from other accounts. Add it all up, and that RMD can be the piece that tips you from one federal tax bracket into the next. When that happens, when income crosses a bracket threshold, the extra tax on just that jump can cost you $5,000 to $10,000 in a single year. Do that repeatedly over a 20 or 25-year retirement, and that is where you get to $40,000, $60,000, or even $100,000 in extra lifetime tax and Medicare costs that nobody planned for. And here is something that makes it even more painful. RMDs are taxed as ordinary income, not as capital gains. If you had sold appreciated stock inside a taxable brokerage account, you might qualify for long-term capital gains rates, 0%, 15%, or 20% depending on your bracket. Your RMD gets none of that preferential treatment. Every dollar comes out taxed at your top marginal rate. There is also a Social Security effect people miss entirely. Up to 85% of your Social Security benefit can become taxable, depending on your total income. When an RMD pushes your income higher, it can cause more of your Social Security to get pulled into the taxable column. You are not just paying tax on the RMD, you are paying more tax on money you were already receiving. Let me be direct about the consequences of missing an RMD or taking less than the required amount, because some people think they can just skip it or delay it without consequence. You cannot. If you fail to take your full RMD, the IRS can hit you with an excise tax of 25% of the amount you should have withdrawn but did not. On a $40,000 RMD, that is a $10,000 penalty, on top of the regular income tax you still owe when you eventually do take the distribution. The penalty is not instead of the tax, it is in addition to it. Now, there is some relief. If you catch the mistake and correct it within 2 years, the IRS may reduce that excise tax to 10%. So on that same $40,000 missed RMD, correcting it in time could drop the penalty from $10,000 down to $4,000. Still painful, but meaningfully better. A widowed school teacher I heard about had $400,000 in her IRA and simply did not know the rules applied to her. Her bank never walked her through it. She missed 1 year's RMD before a tax preparer caught the error. She spent months of stress unraveling it, and she was one of the lucky ones who got it fixed before the full penalty applied. This is what I mean when I say financial institutions are not required to explain the downstream consequences of your account structure. They are required to notify you that RMDs exist. They are not required to show you how RMDs, combined with your Social Security and pension, can reroute your entire retirement tax picture. That conversation is simply not in their job description. One more layer of complexity that catches people off guard. If you have multiple retirement accounts, the rules do not work the same way across all of them. For traditional IRAs, including SEP and simple IRAs, you are allowed to aggregate. That means you calculate each account's RMD separately, but you can take the total amount from just one of your IRAs if you prefer. You have flexibility in which account the money actually comes from. 401ks are different. If you have more than one 401k, say you worked for 2 employers and kept both plans, you must take a separate RMD from each plan. You cannot satisfy a 401k RMD by taking extra from your IRA. The rules are separate, and getting this wrong can trigger the same penalties we just discussed. There is also a rule for people still working past age 73. If you are employed and participating in your current employer's 401k, and you do not own 5% or more of the business, you may be able to delay RMDs from that specific plan until you actually retire. This is a legitimate planning strategy for someone who wants to keep working and defer income, but it only applies to the current employer's plan, not to old 401ks sitting at former employers, and not to IRAs. Now let's get to the part that actually puts you back in control, because there are real moves you can make, and the window to make them is before your RMDs begin. The most powerful tool in this situation is a Roth conversion. Here is how it works. You take money from your traditional IRA or 401k and move it into a Roth IRA. You pay ordinary income tax on the amount you convert in the year of the conversion. But once it is in the Roth, it grows tax-free, And this is the critical part. Roth IRAs owned by the original account holder are not subject to RMD rules at all. The IRS cannot force you to withdraw from a Roth IRA during your lifetime. So the strategy is to convert money during the years between retirement and age 73, your lower income years, when you can pay tax on those conversions at a lower rate than the rate you would face when large RMDs hit later. You are essentially choosing to pay tax now at a manageable rate rather than being forced to pay tax later at a higher rate on a larger amount when you have no control over the timing. For someone with a $500,000 traditional 401k, converting $50,000 per year to a Roth over several years involves paying tax on those conversions now, but it meaningfully reduces the balance subject to future RMDs. That reduction can save significant money in forced taxable withdrawals over your retirement lifetime, well into the six figures for some households. I know a couple who started doing this intentionally in their early 60s. They lived modestly, converted steadily, and paid modest taxes each year on those conversions. When their friends hit 73 and started getting hammered by forced withdrawals, pushing them into higher brackets and triggering IRMAA surcharges, this couple barely felt it. Their RMDs were manageable because they had systematically reduced their traditional account balances over the previous decade. That kind of planning does not require a genius. It requires knowing the rules exist and starting early enough. Strategic pre-73 withdrawals can accomplish something similar even without formal Roth conversions. If you retire before 73, you may have years where your income is relatively low. Using some of your traditional IRA or 401k money during those years, even without converting to Roth, can reduce the balance that will be subject to future RMDs. You pay tax now, but potentially at a lower rate than you would face later. Shrinking a traditional 401k by $200,000 before RMD age can cut your future annual forced withdrawals by several $1,000s. Multiply that by 20 years of retirement, and you are talking about meaningful lifetime tax savings. The math works in your favor when you have time to spread it out. Let me put the full picture together because I want you to see the complete number. For a middle-class household with combined traditional retirement accounts of $800,000, the combination of large RMDs, bracket exposure, additional Social Security taxation, and potential IRMAA Medicare surcharges stacked over a 20 to 25-year retirement can quietly cost $40,000 to $100,000 in extra lifetime outlays. Not all at once. A few thousand here, higher premiums there, a bigger April tax bill every year. It is death by 1,000 cuts. And most households never see it as one connected problem because nobody laid it out in total. That is exactly what the system counts on. Each piece looks manageable in isolation. The RMD hits and you think, okay, I will just pay the tax this year. The Medicare premium goes up and you think, well, income was high last year. The Social Security is more taxable and you think, that just happens sometimes. Nobody connects the dots and shows you the $40,000 or $100,000 lifetime bill those isolated events add up to. Now you see it. And seeing it is the first step to doing something about it. Here's what I want you to do after this video. First, find out exactly what age your RMDs begin based on current law and your birth year. For most people watching this, that is 73. Write that date down and count backwards. That is your planning window. Second, look at your current balances across all traditional IRAs, 401ks, 403bs, and any other tax-deferred accounts. Add them up. Use the IRS Uniform Lifetime Table in Publication 590-B to estimate what your initial RMD will be. Do that math now, not at 72. Third, look at your other income sources: Social Security, any pension, rental income, interest. Add that estimated RMD on top and see what bracket that total puts you in. If the number is uncomfortable, that discomfort is your signal to act while you still have time to do something about it. Fourth, if you are between roughly 60 and 72 right now, talk to a fee-only tax professional, someone who charges by the hour and does not sell products, about whether Roth conversions make sense for your situation. Get a projection. See what your RMDs look like if you do nothing versus what they look like if you convert a portion each year between now and 73. Fifth, If you have more than one employer retirement plan, confirm that you understand which accounts require separate RMDs and make sure your compliance dates are on your calendar every December. You built this money over a career. You made sacrifices to save it. The IRS had a plan for it the whole time, and now you know what that plan looks like. The question is whether you are going to let it happen to you, or whether you are going to use what you know to reshape the outcome. If this video opened your eyes to something your bank or plan administrator never mentioned, do me a favor, hit subscribe. I put out content like this every week specifically for people in your situation. Straightforward, no products to sell, no agenda except making sure you understand what is actually happening to your money. There is a related video coming up next on Roth conversion strategies for people over 60 that I think you will want to watch immediately after this one. It picks up exactly where we left off. You work too hard for this money to hand more of it to the IRS than the law actually requires. Stay informed. That is the only real protection you have.